Welcome to Yahoo Finance Live. I'm Shauna Smith along with Diane King Hall. Let's get you up to speed on the market action here. We have stocks really trading within a tight trading range here with an hour to go until the closing bell. You're looking at the Dow up just 12 points, S&P up about 0.2%, Nasdaq up about 0.5%. Breaking it down by the sector action that we're looking at this afternoon. Materials leading the way, financials, technology, communications, services not too far behind. In terms of what is keeping things in check, utilities and real estate, both of those sectors leading to the downside as you have investors really assessing the looming threat of the debt ceiling standoff that's happening down in DC, and also getting ready for the slew of retail earnings that we have ahead this week, as well as some economic data, Diane.
Yeah, that's right. You're seeing, as you mentioned, stocks in a narrow range as investors just kind of brace themselves for the week ahead. Econ data in focus this week. We've got retail sales and home builder confidence. That'll come in tomorrow, and existing home sales out Thursday. Now, today we got overall household debt for the first quarter coming out rising 0.9%, growing over $17 trillion. That's according to the New York Fed. That's the latest data on that front. Joining us now to break down the consumer sector is Keith Lerner, who's Truist Chief Market Strategist. Keith, thanks so much for joining us. Let's get right into just kind of this latest data that we had come out today from the New York Fed. What's your assessment of that?
Hey, great to be with you, Diane. And Shauna, regarding the New York data, which one are you talking about specifically, the household data?
Yes, the household credit.
Yeah, well, I mean, I think what we're seeing a little bit is household debt is normalizing from very low levels. So I think the consumer's balance sheet in totality is still relatively healthy. But our view is, as the compounding impact of these rate hikes in conjunction with tighter lending standards, will filter into this market and the economy in the second half and slow things down. But I think it's going to continue to be a gradual move down, especially if you think about this year to date, we've averaged almost 250,000 jobs a month. So I think in that environment, which is still much stronger than before the pandemic, I think the consumer will hang in there. But again, we expect a gradual decline or pullback as we move into the second half.
Keith, when we talk about sticking with New York here with the manufacturing activity, that number that we got out this morning, certainly we did see a slump in activity. I know you were saying that maybe the momentum that we had seen, the resilience here in the consumer, we might start to see that picture shift a little bit. What do you see just in terms of manufacturing and how that's going to factor into this economic slowdown?
Well, I think we've had this divergence already in the overall economy, and folks that are looking at the manufacturing side, a lot of that data has been weakening for some time. We've had this divergence between manufacturing that's been weakening versus the services that has stayed relatively strong. I think when you see things like the Empire reading this morning, those regional surveys tend to be extremely volatile, but I think the message is that continues to be the weak side of the economy. We expect that to continue to be some weak. I think later on this year, we expect the services side to show more of a slowdown as we expect initial jobless claims to actually start to perk up. And that's one of the things we're watching more closely real time on a week-to-week basis. Last week, there was some funkiness in the data as far as the initial claims. But I think if you're looking forward, then two main things we're focused on is initial claims and then also credit trends. We're starting to see default trends move up on the margin. And again, that just tells us that things are slowing down.
So, Keith, I got to ask you, before we kind of dive into the earnings in the week ahead, we've got a big focus on retail this week. But before we dive into that, let's kind of broaden this out to you talk about, are we in a new bull market, or are we experiencing, outside of kind of recent trends we've seen over the past 2 weeks, are we experiencing a bear market rally?
Yeah, it's an interesting question because we're about 7 months off the low. And what we did in a recent publication is we outlined the bull and bear case. We are more on the defense side. So let me lay that out firsthand. But if you look at the October low, I will say you had some things that were consistent with a market low. You had really negative sentiment. You actually found the low on a sky high inflation number as well. And you've had a nice move off the lows. But I will say other factors, I think, leaves in question if this is a new bull market. Normally, the first phase of a bull market is like a rocket ship. It takes off. You're up on average over 30% by now. We're only up about 15%. Also, small caps, cyclical areas of the market tend to lead. What do we see right now? Small caps are underperforming by a wide margin. Transportation stocks are underperforming as well. And then financials are also underperforming. So if this is a new bull market, it's not nearly as strong as most bull markets at this same stage, 7 months off the low. And some of these more cyclical areas aren't showing strong performance. And the breadth of this market is still relatively weak. So we're still skeptical. I think to keep it more simply, I think we still think we're in this broader, choppy trading range. And it's not at this point, it's not a compelling opportunity from a risk reward standpoint.
Keith, what's going to get us out of this very narrow trading range?
One, maybe this debt ceiling that we're talking about. I think one of the best things for the bull case is positioning is still relatively short this market. So listen, I think the most likely view is that this whole debt ceiling fiasco gets kicked into the fall, where you actually have then the appropriations bill and the budget for next year, where you're more likely to run into something like a government shutdown. But I will say, if we, on the upside, I think maybe a more positive resolution. If you break above 4,200, that would bring in some technical trading. But more or less, I really think we're trapped, about 3,800 on the downside in the near term. And then if we break above 4,200, I still think the upside is probably capped to around 4,300. So I think we're here for some time. And I think really what it's going to be is, how you're positioned within the market. And for us right now, we're overweight things like technology, communications, and also more defensive areas like staples.
Okay. Speaking of staples, you mentioned you're overweight consumer staples. We've got a big week ahead earnings season rolling on this week with a lot of retailers out. You've got Walmart, Target, and Home Depot all set to report their latest quarterly numbers in the coming days. Again, you mentioned you're overweight in the consumer staples. What are you expecting to see this week?
Yeah, I think the earnings will be okay, right? I mean, going back to if we have 250,000 jobs, or we're creating 250,000 jobs a month, that's well above the average. I think the consumer is still okay, but I think you'll continue to see this trade down, which we saw last quarter, and that should benefit, some companies on the margin, like Walmart relative to Target, just seeing that trade down. And then I think it'll be more interesting, like Home Depot, if you start to see, people are locked into their home with their 3% mortgages. Are you seeing folks, do more renovations? Because if you look at the stocks there, they've been relatively flat the last couple of months.
Keith, how do you make sense of the consumer as of late? Because when you take a look at the retail sales numbers that we're going to get later this week, it's actually supposed to grow for the month of April. Yet, like you're saying, we have started to see the consumer trade down just a little bit. When do you expect to see more of a material impact on some of these retail names?
Yeah, our view is that you'll start to see more of a slowdown in the economy in the second half. That's consistent with when the yield curve inverted last year. That's also consistent with the lagged effect from Fed policy. And then more recently, if you think about the tighter lending conditions, that also works with the lag. So, our perspective is we'll start to see more of that pickup in the unemployment claims in the second half, and that will weigh on some of these retailers, and the retailers in general tend to be more cyclical in nature. So I think right now, the economy is, continue to move forward, to kind of grind forward. So therefore, these stocks have done the same thing. But I think as we move into that, later stage of this year, we'll start to see some of that weakness manifest itself. And that's why we're right now in neutral, the discretionary area. But if you think about staples relative to discretionary, staples are less economically sensitive, and that's one of the reasons why we like that sector more relative to discretionary.
It's kind of a need, not a want. I get that. All right. So besides earnings, we've also got some deal flow activity in focus. Today's big headline really seems to be deal flow activity when it comes to big deals like Microsoft and Activision. You also had some big activity in energy and gold mining. In terms of Microsoft Activision, you had news out today. The European Union regulators have approved the proposed $69 billion acquisition. What's your take on how deal flow activity factors into your outlook on the market action?
Yeah, I think about the ones you discussed today, they're really not related. They're one-offs on specific situations. I think as the economy slows down and some of these big companies have a lot of cash, they're going to look to how do they maintain margins, and one way to maintain margins is to do mergers and acquisitions. So I think that will continue to stay steady, especially, we're seeing this diversion within the market, right? If you think about the biggest stocks in the market are outperforming, from mega cap are outperforming the S&P is outperforming mid caps, and mid caps are outperforming small caps. So it makes sense if you have a currency, which is your stock, if you're a big company, that you can use that to buy some of these companies that are still down, as I mentioned earlier, 10, 15% off the high. So I think we'll continue to say that is a buffer for the overall market and are likely to to see that continue, especially if we see a slower economy and these companies want to see some growth in sales. They'll have to do it, outside of just organically by doing more mergers.
Yeah, Keith, when do you think, though, that we're going to get back to those more quote unquote normal levels? Is that something that we might not see until 2024?
As far as the mergers and acquisition side, or? Yeah, I mean, I think, one of the challenges is it's also more expensive to finance some of these acquisitions, especially on the debt side. So I think that we'll likely see that when we start to, when some of these companies feel more confidence on the other side, that they can see that the economy is going to find the low and move up on the other side, that they will, spend more capital to take over other companies. In the meantime, I think what you'll see is more bolt-on type acquisitions. But again, the big mega caps companies, a lot of them have cash. So I think they'll be looking from some larger ones, but in general, I think we'll see more of these bolt-on type of acquisitions.
Cash is king once again. All right, Keith, thank you so much for joining us today. We are just getting started here on Yahoo Finance Live. Coming up, there is still no agreement in sight on the debt ceiling. We discuss the latest on the other side. Later, how many social media apps like TikTok change the way consumers are paying their bills? And doing your taxes could look very different next year as the Biden administration is considering creating a government-run alternative to TurboTax and H&R Block. We break that down and much more.
We got an inside look at the industrial economy here at Goldman Sachs' Industrial and Materials Conference. We heard from the biggest names in this space, including the CEOs of RXO, Clean Harbors, and Johnson Controls. Here are our three big takeaways from the event.
First up, artificial intelligence, AI, the buzzword that's got Wall Street's attention. It's starting to transform the industrial sector, with more companies jumping on board.
We've been investing in AI for over a decade. And so if you think about the pricing algorithms that we've got that allow us to have best-in-class margins, it's because with every load that goes into the system, our algorithms get that much smarter on a pricing perspective for both the customer and the carriers. We're also using AI for customer integrations. What we see is that we're able to have our employees be able to do more per day.
A bull market awaits. It's almost like, what recession risk? The industrial economy is seeing signs of a recovery.
Today, we're in the start of a very significant, infrastructure build in the U.S. Some might call it a U.S. manufacturing renaissance. The level of spending that's occurring today is unprecedented. And so the tone coming out of the conference the last 2 days has been very bullish.
Worker shortage. Business leaders are having trouble hiring and retaining top talent.
We've had trouble. Our turnover, it's not just hiring people, it's retaining the people we have. And lowering our turnover rate down to pre-COVID levels, which has been terrific. So in my mind, I think it's as important to keep our own employees and provide a good career path for them as all it is to hire more capable bodies. It is improving, more holidays, better healthcare costs, providing a career path for our employees.
President Biden is set to meet with congressional leadership tomorrow to talk about the debt ceiling. It comes as House Speaker Kevin McCarthy says the two sides are still, quote, far apart. Joining us now is Brian Gardner, Chief Washington Policy Strategist at Stifel. Brian, it's good to see you again. So certainly the clock is ticking right now. Time is running out for both sides to reach a negotiation. What's your assessment just of where talks stand and where the biggest gaps are right now in reaching that potential agreement?
So I think the tone is a little bit better than we've seen the last couple of months, but it's still not great per Speaker McCarthy's comments. So I think the two sides remain pretty far apart. I think there are a couple of areas that there's an opening to an agreement. Rescinding COVID funding is one example. Energy permitting is another. The problem with energy permitting is, what do you mean by energy permitting? And there are competing ideas on energy permitting, and the devil's in the details. And then you get to some of the even stickier problems, which are work requirements for very social safety net programs, and then the cap on spending. What's the dollar amount of the cap? How long is the term? How long do those caps stay in place? So I think there's some areas for possible agreement, but I think there's also a couple of areas where they're still pretty far apart.
Where they're far apart, Brian, Diane here, what do you see as the potential landmines ahead in terms of reaching a deal on the debt ceiling?
So let me point out two. One is going back to that spending cap issue. I think Republican, and this point is tied to the next point, I think Republicans want substantial cuts. They want them, and they want a cap for a growth of government spending over a long period of time, 10 years. And I think the administration and many Democrats probably go along only with a shorter time period. Let's just for a second assume that they can get some kind of deal on spending and the other items we just talked about. The other potential pitfall is what I'll refer to as the T factor, the Trump factor. Last week on a CNN town hall, he mentioned that if Republicans don't get massive cuts, that they should default. Now, we don't know what those massive cuts are, what is and is not massive, but if Speaker McCarthy and the president get a deal that is not up to snuff for former President Trump, and he comes in and torpedoes the deal, it could scare away House Republicans. The whole house of cards can then come down. So it's the details of the plan and then the politics of the plan. How does that play into the 2024 elections? And does the former president see it in his interest to sow chaos? I mean, he feeds off of disruption, and this would be very much up his alley.
Brian, what about a short-term suspension right now, an agreement on there just in terms of a short-term deal? As it stands right now, both sides don't seem to want to go that route, but could we start to see maybe that gain some traction? And what does the timeline look like on that?
Yeah, so I pointed out back in early April that a short-term suspension was a possibility. As you noted, both sides have stayed away from it and are downplaying it. I still think it's kind of a fail-safe option, pull in case of emergency, pull glass in case of emergency. It also could be used if they get really close to that X date, whenever that is, and they're close to an agreement, and they just need to buy themselves, some extra days to hash out some last-minute details and actually write the legislative language. Then in that scenario, you could also get a short-term suspension. So I hear what the parties are saying, that they don't want to do a short-term suspension, but I do think at the very last minute, it becomes a viable option for them.
So, Brian, we've been here before. We've seen this before and back in 2011. And you see this kind of political posturing, political brinksmanship. Let's play out kind of a worst case scenario. Let's say they don't do a deal. What's the worst case scenario from your view?
So the worst case scenario, and they don't get a deal, there are a couple of implications. First of all, I don't think a no deal scenario is priced in, at least to the equity markets. I think equity market investors have taken this sanguine view that, oh, they're going to get it worked out this time, and why me worry? That holds until it doesn't. So if Congress and the administration does drop the ball, it's not priced into equity markets. Then, kind of broadly speaking, what does it mean? Well, I don't think there's a default on the table for bondholders. I think that Treasury will prioritize them. I think bond payments will go out on time. It's the downstream effect, if you want. Social Security, that probably gets paid. Military payroll probably get paid. But on any given day, Treasury only brings in 75 cents in revenue for every dollar that it spends. So at some point, somebody's not getting paid on any given day. And is that a vendor, is a contractor? So I think upstream towards the bondholders, I don't think there's an immediate impact. I think downstream towards other payments within the federal system, that's where you start to see repercussions. And I think that just kind of, ripples through the economy.
Brian, when it comes to the equity markets, like you said, investors have largely shrugged this off so far. When do you think we're going to start seeing some jitters, maybe some volatility enter the market because of this standoff?
Yeah, so I think when you start, if we get to the point where the White House turns a little pessimistic again, because it's been pretty optimistic over the weekend. So at that point, I think investors may rethink their positioning. Going back to 2011, I mean, the markets kind of shrugged this off all year until after July 4th. And we came back in early July from the holiday. It's at that point that investors realized, they mean it this time. We could get to an X date with no deal. And so I think if the tone changes, I think we're so close to that X date that investors will start to pay attention and reposition themselves.
And Brian, I remember that the 2011 and leading up to that, I remember the U.S. credit rating, the stellar credit rating was slashed, and it was kind of a very shocking moment. Could you see that happening again?
So, sure. So S&P downgraded its rating back in 2011. The other rating agencies did not follow suit. We could have the other agencies join in. S&P could double down and further downgrade. What the impact of that is, we don't really know. I think a lot of investors, a lot of observers were surprised in 2011, even after the downgrade. It didn't result in an immediate increase in interest rates. We were in a low rate environment, and we were going into an international sovereign debt issue with Greece and Italy having their problems. So there was a flight to safety. Rates on U.S. Treasuries declined. The bond market in the United States rallied. It's a different set of circumstances this time. So maybe rates do go up this time if there is a downgrade. I don't think anybody really knows at this point, but it certainly would be a possibility.
Hopefully we don't have to find out this time around. Brian Gardner, always great to speak with you. Stifel Chief Washington Policy Strategist. Thanks so much.
Thank you.
All right. Let's get you caught up on a few of the tickers that are trending on Yahoo Finance. And for that, Alexandra Canal is here with us. Ali, take us through what you're watching.
Hi, Diane. A few movers out this afternoon, one being C3.ai. The stock is up more than 24% right now after the company's Q4 earnings came in above expectations. The company also raised its outlook and cited that interest in applying predictive analytics, quote, has never been greater. So this is one business that's clearly riding the AI wave, which we've seen across multiple industries. In fact, back in February, C3.ai saw shares surge 100% over the span of the month, which is when investors really started to hear more about OpenAI's ChatGPT. Now, today's stock boost does come after some turbulent times for the company. Earlier last month, we had a short seller letter alleging that C3.ai was involved in, quote, aggressive accounting to inflate its income statement. The company did respond with a statement of its own, writing that the letter appears to be a highly creative and transparent attempt by a self-acclaimed short seller to short the stock, publish an inflammatory letter to move the stock price downward, then cover the short and pocket the profits. Year to date, C3.ai is up roughly 100%. But while that stock is up, SoFi Technologies is down. That's another stock I'm watching this afternoon. The stock off about 4.5%, a little less than that, on the heels of a Wall Street downgrade. Wedbush analysts downgrading the stock to underperform from neutral, also slashing their price target to 250 cents a share, down from the prior $5 a share. In a note released today, the analyst said the financial services company could be, quote, nearing a tipping point on the fee income it recognizes from loan applications and sales, warning the fee income could decline significantly. Wedbush added it thinks that SoFi's capital levels may be overstated using fair value accounting, and that they don't believe SoFi will change their accounting methods in the near term. On top of those headwinds, the analyst said they think the company may look to raise capital this year to support growth. So Wall Street just continuing to remain a bit skeptical about this stock, with shares under pressure throughout the entire day, although they have recovered from their lows earlier this morning.
Allie, another big trending ticker here, actually two, Microsoft and Activision getting some welcome news over in the EU and approval there. What are we seeing in the stock?
Yeah, so Activision, like you said, a top trending ticker on the YF site right now on the heels of that deal approval. It's up just modestly, and Microsoft shares, they're trading relatively flat right now. But the European Union's antitrust regulator saying in a press release that its approval is conditional on Microsoft's full compliance with agreements to enter long-term licensing deals that permit gaming consumers to continue accessing Activision's games, which does include Call of Duty, a very popular one there. Now, of course, the story, it's far from over, considering the UK rejected the same plan last month. And then over here in the US, the Federal Trade Commission is continuing to evaluate the deal. Yahoo Finance's Dan Halley and Alexis Keenan have a full explainer up on the website right now. They really dive in to the nuances surrounding this potential deal, and clearly a lot of interest as we continue to wait and see whether or not this will get the full approval necessary.
Exactly. We've been waiting for quite some time. All right, Allie Canal, thanks so much. Well, coming up, another trending ticker here, a shakeup at Shake Shack, another food giant caught in the middle of a proxy battle with an activist investor. Stick around. Looking at the stock up just about 8%. We'll be right back. Let's dive into some trending stories and stocks that we're watching here in the final 30 minutes of trading. This story got my attention today. CEO pay. The majority of chief executives at S&P 500 companies ended the year with smaller pay packages than they were initially awarded. So a perfect example of this, looking at the guy right now on your screen, Elon Musk. The stock awards that he got for running Tesla lost nearly $10 billion in value last year. Now, it's not a huge surprise considering that Tesla shares fell about 65% from January 1st, 2022 through the end of the year. We've got Josh Schaefer and Brooke DePalma here sitting at the desk to break all these trending stories down. Josh, I'm going to send it over to you first, just in terms of the trend that we have seen in pay. And when you take a look at the underperformance of a number of these companies within the S&P 500, not a big surprise.
Not a big surprise. The Elon one's sort of funny in some ways, right? Because who sent Tesla stock down maybe arguably the most over the last year was Elon, selling some of that stock and all the things he's done with Twitter. So in some ways you could argue Elon maybe did some of that to himself, which was interesting. And then I also just think broadly when you think about this, I mean, this is sort of what you want as an investor, right? You want these executives to be attentive to the stock price.
Right.
That's the whole point of why these structures are built out this way. So you see a company like Amazon, Andy Jassy, making significantly less money this year, because guess who made significantly less money last year too? Those shareholders, right? They lost a lot of money in that.
Yeah, and a lot of the way the pay packages are set up is more of it has to do with the stock price. And then of course there's the vesting schedule that plays into that. So the vesting schedule can affect, you know, when they actually receive that pay for performance, if you will. So to your point, Josh, it matters how the share price does to, you know, they have to be incentivized to help the company perform, or else they don't receive any kind of benefit from that. But one thing I did notice about the kind of the holistic picture of pay, although it was down, it's still not off that much. I mean, it was a record in the prior year.
Musk was off $10 billion.
Yeah.
But for some people, it's off a pretty significant amount.
Yes, for some, yes. But in general, when you look at CEO pay as a whole, it wasn't.
Yeah, and on the flip side, I mean, this could work in the C-suite executives' favor. I noted in the report that some 140 CEOs earned more money than they initially expected. 46 companies, the CEOs ended with at least double of what the board planned to pay them. And so certainly what we're seeing here is this timing of investments could work out in the CEO's favor if the stock does perform well, and investors awarding this at the end of the day. If they're performing well, then ultimately they're getting more money at the end of the day. So it's a win-win there.
And the other thing too, Brooke, that's just interesting to point out here when you look at some of the top paid CEOs, right? You have Sundar Pichai at Alphabet and Michael Rapino at Live Nation. Those two come to mind. They're not only the top paid, but also we're very much in headlines in 2022, not always in positive ways, right, guys? We've had analysts essentially call for Pichai to maybe step down. They just had a positive meeting last week, obviously regarding AI, but he has not been in positive limelight. Live Nation, you think about Ticketmaster and that whole saga in 2022. I'm not sure if you just read headlines, you would think those would be the two CEOs leading that in 2022.
Yeah, exactly. It is a bit surprising. I didn't think about it that way, but certainly when it comes to Live Nation, I think that argument might be a little bit stronger than Sundar Pichai, given the track record.
I was going to say not Sundar Pichai. He'll be fine.
Right. All right, another thing I've been keeping my eyes on today, guys, is the sports betting space, as Michael Rubin and Fanatics have officially made their move into sports gambling. So the private company, mostly known for their sports apparel business, has entered into an agreement to buy PointsBet USA. The $150 million purchase will provide Fanatics with access to licenses for mobile sports wagering in more than 15 states. But really what caught my eye here, we can talk about Rubin and Fanatics getting into sports gambling. I think it's fascinating. $150 million for access to 14 states in licensing. If I told you that in 2019 and 2020 for people that followed the space, they would be very surprised. That is an undervaluation compared to what we saw several years ago. I had people tell me that today. And I think what's interesting to see with that is essentially what more consolidation do we see? Sean, I know we've talked about this a lot with DraftKings in the past, in FanDuel, and sort of that market domination you're seeing at the top. Well, now you're seeing as valuations drop, who do some of these bigger companies try and scoop up? And it feels like we're just talking about 3 or 4 players at the top and everyone else is out.
We are, which I think is something that didn't necessarily catch us by surprise, given the fact that some of those names have such a strong hold on this market. And also there's just questions about the growth here and what that is exactly going to look like over the next couple of years, just in terms of additional states coming online, and what exactly that looks like, even for the larger players within this space. Whether or not Fanatics is going to be successful in this, I have a lot of questions just in terms of their ability to compete with so many of those players that do have that larger footprint.
Yeah, what really surprised me as I was diving into this is that year-to-date shares of DraftKings are up more than 100%. Right now, up 106%. So the excitement is still there. When also, as I looked into this, is that yesterday marked 5 years since that Supreme Court ruling that ultimately allowed gambling on sports. That was an overturn from a ruling back in 1992, a law that went into effect then. And so ultimately, this reversement that we've seen over the past 5 years, the excitement seems to be still there based upon how shares performing of DraftKings. But in addition to that, I found a quote from the late Ruth Bader Ginsburg, and she said that there is no cause to deploy a wrecking ball. And I just found that so fitting for this exact moment. We are just seeing so many players get into the space, and perhaps a wrecking ball that she said.
Was that pun intended? So many players in this space. And some consolidation of the players, some people making the draft, some not in this
Tons
space.
of puns that can be used.
But yes, no, you make a good point about just what has happened within this space. I mean, once upon a time, it just was not legal. And then the acceleration, and but we've seen some slowdown in terms of, as you mentioned, the states adopting legalized betting. It's not going to be the pace that we've seen in the past couple of years. I mean, only a couple states set to come online with legalized sports betting, and so there's some headwinds in that respect.
And what's really going to happen here too is Fanatics is going to play a big role in that profitability story we talk about with these sports books, right? Because now you're bringing in a company that wants to spend when you've had companies trying to cut back on spending to acquire customers. So I think that's the looming question that we leave here today with on this story is how much can Fanatics disrupt the space that feels like it has been headed toward a little bit of consistency.
What is the thought process out there, though, just in terms of how big of a threat? Are they even a threat to DraftKings?
Michael Rubin says he wants to spend $1 billion. If he wants to spend $1 billion, then he's probably going to take some market share from DraftKings or FanDuel, right? And he has 94 million customers that are Fanatics customers that they have direct email access to. So they have the market. It's just whether or not they can bring people over.
And what I love about this story is it's Main Street and Wall Street both getting in. And I have something else that's also Main Street and Wall Street looking both to play here. Another food giant caught in the middle of a proxy battle. Shares of Shake Shack on the rise after activist investor Engaged Capital, which has a 6.6% stake in the burger chain, is seeking 3 seats at the board, claiming that it has ways to double Shake Shack's profitability in the next 2 years. Now, in response to the activist investor, Shake Shack told Yahoo Finance in part, "We are executing our strategic plan and making substantial operational and financial progress. We are guiding full year 2023 to be a record year with expectations to return restaurant level margins to 19 to 20%. Now, this is one of the many activist investor situations we've heard of lately. Goldman Sachs recently came out with this report. They identified 4 financial variables representing potential sources of vulnerability that will cause activist investors to step in. They include slower trailing sales growth, lower valuations, weaker trailing net margin, and trailing 2-year underperformance. Now, Shake Shack, it's important to note here, has had a great year. Their year-to-date performance is up more than 50%. Perhaps, Dan, you were to mention that. And it's really interesting to see over the past 2 years, though, shares are down 15%. So lots of pressure from lots of different areas here.
Yeah, but like to your point about the Wall Street versus Main Street story with the Shake Shack, I mean, listen, we just had Shake Shack last week here in the office. So it's certainly...
So what do they have to be worried about?
You had a whole corporate newsroom.
But we're not the only ones. I mean, they're worried about volume in urban cities falling. I mean, we don't have employees here Monday through Friday like we did pre-pandemic.
Yeah, but I also think, look, this points to a larger trend that's going on Wall Street right now. When we take a look at the activist investor activity and what exactly that has looked like, because when you take a look at 2022 numbers, Bloomberg has been compiling data for years now. It was a record-setting year when it comes to some of that activity that we're seeing from activist investors here. Over 632 activist campaigns we were looking at in 2022. This year so far, Q1, 69 new campaigns here, Josh, the second highest quarter on record since 2019. So these activist investors, they're pushing change. We know a number of these companies have underperformed, and this is what they're doing.
Well, it's the overall underperformance, right? And it gets to what we were talking about earlier with companies getting bought. you're going to see these valuations and companies go down and people start to question the numbers, and things were frothy, say, a year and a half ago, and now things go down. And so you get into either acquisition with what we were just talking about with PointsBet in the sports gambling space, maybe activist investors, but it's certainly an overall macro story we're talking about, and we're talking about Shake Shack right now, but it's been interesting to see too, Shauna, when you were pointing those larger numbers. I mean, activist stakes at Disney. You're talking about big companies where people have been taking activist stakes too. We're not necessarily talking about smaller companies.
Yeah, and really quick today, you saw Elliott Investment calling for a boardroom shakeup over at NRG Energy. I don't know if that's what you were going to bring into the conversation.
I was going to say that not always does it end up in the opposite party's battle. We saw some McDonald's last year. McDonald's actually ended up winning the proxy fight. And so it's just interesting to see the way it will play out.
Right. And I want to switch gears to, we've talked about some kind of positive and interesting stories. This is kind of a little bit on a downbeat note, catching my eye is just this slew of bankruptcies that brewed over the weekend. It's not just Vice Media. That one's a big one that we focused on today. Vice Media was this high profile one which filed today. Vice, you'll recall, once had a valuation of $5.7 billion, a far cry from where it is now. But there were several bankruptcies, including one in the healthcare space. Envision Healthcare, which operates a physician staffing service for emergency rooms and ICUs. Now, that company says it was hurt by a national shortage of clinicians and cited the impact of inflation on its business. And to give this a broader perspective, recent S&P data shows that corporate bankruptcy filings are at the highest level in more than a decade. So they're piling up and so far are outpacing last year's levels. Among the biggest this year, of course, we know SVB. And recently we had Bed Bath & Beyond, which went to the beyond.
Yeah,
sorry, I can't help it.
There's been a number across the board. When you take a look at some of the trouble, specifically within the retail space, since you mentioned Bed Bath & Beyond, we also had Party City. We also recently had David's Bridal filing for Chapter 11 protection once again. So as we see the consumer pull back in spending, obviously retail has been a sector that has been hit extremely hard. And we've talked to Jerry Storch a number of times on this program. He's the former CEO of Toys R Us, and he told us that there are more and more bankruptcies to come this year, as we certainly do know that in retail it's going to be an extremely challenging landscape. But I think more broadly speaking, when you take a look at the trouble with SVB and now the tight the pullback that we have seen in lending, the tighter lending conditions, obviously that will also influence the number of bankruptcies.
I think it speaks to how hard the environment is right now, too. I know you guys have spoken to several retail analysts on air that basically say, even if you get the capital, when you look at Bed Bath & Beyond, they got funding over the last couple months to try and resolve this problem. But then you have to get things on shelves and you still have to sell them. You still have to get people back in the store that people weren't in, and then you have to sell that inventory. And when we're talking about potential consumer slowdown, it's just a really tough environment right now. And one other stat I'll point to too, sorry, Diane, you were talking about overall bankruptcies, Chapter 11, Chapter 22, what they call the double bankruptcy, right, to refile again. That's also at its highest level in a decade. So you're seeing that.
David's Bridal did that.
You're seeing that take hold as well.
Yeah, and another East Coast retailer that's under pressure is Christmas Tree Shop. They recently filed for bankruptcy, and they cited that their restructuring will reduce the company's debt. They also noted that they were impacted by a slowing consumer demand fueled by inflationary pressures and increased interest rates. Now, they're only closing 10 underperforming stores and keeping a majority, about 80 stores I think they have right now. But ultimately, this is something that we're hearing, as Shauna noted, is that customers are spending less. You noted that they still have inventory on the shelves. And so ultimately, how do you refuel that consumer spending pressure, or rather consumer spending behavior that we saw similar to the likes of 2021 when, say, the economy was booming, people were spending more than ever. And ultimately, that was largely due to stimulus that was out there.
Wow, we've covered a lot today. Activist investors, bankruptcies, CEO pay, and deals.
Sports betting.
We have got it from A to D. Maybe not A to Z. We'll get there. All right, coming up, what's causing sticky inflation? We speak to an economist on the other side for his answer. Stay with us to find out. The average age of vehicles on the road is older than ever. Yahoo Finance Autos reporter Pras Subramaniam is here with the details. Pras?
Yeah, hey, so basically S&P Global Mobility kind of tracks these average ages of cars over years. And they've been hovering around 10 for a while now, but 12 and a half it hit last year, the biggest on record, the largest on record that they've been tracking. So kind of a big deal. 12 and a half years is a long time, over a dozen years. They talk about how things like the pandemic sort of made that happen with the part shortages, fewer supply on dealer inventory, and also pricing, right? So that we saw pricing go up. The average price of a car, a new car, $48,000. I mean, that's a lot for people to swallow. And in addition to the fact that you have rates climbing, right? You have rates climbing up steadily higher since last year. That's affecting car prices and making it harder for people to make that decision to pull that trigger. But things are changing. There's more supply now in dealer lots. There are incentives that are coming now on the lot for new cars. I've seen that on myself personally for new cars, Ford, Honda, GM products too. So that's changing, but still, automakers want to sell cars at a higher price. Used car prices are still pretty high. It's making it hard to get rid of that old car.
Still very high, and it's tough for people to even find some of the vehicles that they want to buy given the current environment. Pras, what does all this mean for EV adoption? We already know it's been slower than maybe what we had initially anticipated. You would think when you're looking at numbers like these, it's going to take even longer.
Yeah, you know, KBB found this week that it was, at a report that said $55,000 is the average cost for a new EV. Significantly more than a regular car. So you're talking about affordability is an issue here. Yes, you got EV tax credits for certain buyers and for certain cars. It's not enough to really pull that down. So from an adoption point of view, you got to think that this is going to hurt it from a price point of view and also from a supply point of view as well, because there isn't enough of these EVs out there right now.
Pras, I got to say what you said about just the cost of a new car, it has me holding on. So mine is 8 years old. I do not have an EV. I will be holding on to mine longer. So I don't know, maybe I'll end up I don't know if I'll end up at 12 years.
Hey, you might like it. I mean,
right? Yeah. I mean, it gets me from A to B. So
that's all that matters.
Exactly. All right, Pras, thank you so much as usual.
All right, let's talk about inflation here. Inflation has eased year over year, but has remained sticky in areas like food, energy, and services, despite the Fed's decision to keep raising rates here. Now, joining us is Paul Donovan. He's UBS Global Wealth Management Chief Economist. Paul, it's good to see you here. So obviously the rising rate environment, the Fed doing that because they want to get inflation under control. We're starting to see it ease just a bit. What's your assessment just of where things stand and the biggest driver of inflation today?
Well, what we've had in the States and elsewhere, of course, in the developed world is sort of three distinct waves of inflation. So the first wave, the temporary inflation of 2021, when everyone was rushing out and buying washing machines and televisions and so on, that's gone. That's gone into deflation territory. So part of the US economy is in deflation. But then just as that wave was peaking and starting to come down, we then get the second wave of inflation, which is caused by the war in Ukraine. That's a supply shock, and that's around the energy prices. And then as that has faded, what we've been seeing is a very unusual form of inflation, which tends to occur only in certain sectors, and that is profit-led inflation, where companies are sort of sneaking in margin expansions, telling that their customers, no, it's all due to this other problem, but actually managing to get a margin increase in as well as passing on the costs.
Okay, Paul, you say some of this is transitory, so you say some of this is gone. It doesn't feel like it when I'm looking at certain items. So what can the Fed or governments do? Is there really anything they can do to address it, or is it here to stay certain levels?
Well, with the durable goods, they don't need to do anything because they are falling. You know, a television costs substantially less this year than it did last year. If you are talking about energy, that's come off the boil, and there's not much government can do about energy prices, to be perfectly honest. Gestures with the Strategic Petroleum Reserve, but that's about it. With profit-led inflation, there are two routes. You can squeeze demand because any company will find it difficult to raise prices if demand is in free fall. But that's not desirable because, of course, that has other consequences. Alternatively, you can try and communicate better. Say, actually, no, this is not a justifiable cost increase. This is a margin expansion. And by drawing attention to this, you can get consumer rebellion. And, of course, you can threaten things like competition inquiries, which is exactly what's going on here in the UK, where last Friday, Parliament announced that they were going to be investigating food producers and supermarkets as part of an investigation into price gouging or excessive price increases. The Competition Commission has got involved, and all of a sudden, supermarkets seem to be starting to cut prices of basic foodstuffs on shelves.
Well, why don't you think we've seen more of a pushback from consumers here in the U.S. of these higher prices? Because it largely seems like consumers have been willing to pay the new price tag up until now.
Well, I think there's a variety of drivers of this. So the first is that in the world of social media, we get lots of sensationalist stories coming around about massive shortages here and the disruption of war there. And it makes it quite easy to sell a story to the consumer saying, no, we've got to raise the price of bread because the price of wheat's gone up. And economists say, well, price of wheat's got nothing to do with the price of bread. I mean, bread's all labor cost. Wheat is incidental, but the supermarkets or retailers get away with that sort of story. So that's part of the process, I think. We are also, it should be said, seeing quite a lot of variation in the United States. I don't wish to criticize, but your monetary union isn't working terribly well at the moment. You've got big differences in inflation. And a lot of that, I think, is reflecting the fact that in some areas of the economy, either because of weaker demand, weaker incomes, or just resistance, consumers are refusing to accept the price increases, whereas in other areas of the economy, consumers have perhaps more savings, they're more affluent, they're believing the stories, and they're just accepting the price increases. So the fact that there's so much difference in things like food price inflation between different regions of the United States is quite telling. I think that when resistance takes place, it does work, but not everyone's got the message yet.
So possible consumer rebellion. I've definitely seen what you're talking about, especially on social media with regard to what's going on in the UK, and the terminology that is used is the cost of living crisis. And here we call it inflation being sticky or sticky inflation. Paul, I got to ask, to your point about wheat, et cetera, how much does the Russia-Ukraine war play into the current level of inflation?
Well, the thing is, commodities aren't that important to inflation. The example I always use is milk. You go and buy a pint of milk. You think, well, I'm buying milk. No, you're not. You're not buying milk at all. About 40% of what you pay in a supermarket is actually going to a farmer. The rest of it is sort of advertising and packaging and retail and wholesale prices and distribution and stuff, maybe labor costs. So we have this rather naive idea that, the impact of the Ukraine conflict on commodity prices directly translates into what we're paying in the stores. And actually, it's a fairly small part. Commodities are typically around 10, 15% of the price that we would pay for most goods, and of course, far less when it comes to services. But as I said, this narrative, this story that war is terrible and you're reading about it on a daily basis, you're seeing it on your social media, that gives you the idea that the price increases you're being asked to pay are justified, even if it is just a fig leaf of justification covering up a profit margin expansion.
Inflation numbers here, they're easing a bit, but still 4.9% on a year-over-year basis. Paul Donovan, always great to have you. Thanks so much.
Meantime, the IRS is releasing a report this week on the possibility of a free government-run tax filing service. Our very own Rochelle Akufo is here with us to break this down. Rochelle, what do you think we can expect from this IRS proposal?
So as you mentioned there, it's a combination of the IRS and the US Digital Service. Now, they've been very tight-lipped on the details, but the Wall Street Journal and the Washington Post reporting that the agencies will lay out plans for this free government-run self-filing tax service this week. Now, that's meant to focus on some of these straightforward tax filers, so not if you have a lot of these complex tax issues. And they're supposed to be starting with a pilot test group in January of 2024. Now, all of this really shouldn't come as much of a shock. I mean, the Biden administration and consumer groups have been pushing for lower filing fees, lower fees for consumers overall. And $15 million was set aside in the Inflation Reduction Act to look into a direct e-filing program. Now, according to IRS estimates, the average American spends about $250 each year in tax filing services. If you look at TurboTax parent company Intuit and H&R Block, they make up the bulk of the self-filing tax market. Now, the popularity of e-filing has skyrocketed, climbing 100% since 2009 before paring back just a little bit since COVID. And of course, those two names with the lion's share there, having a bit of an issue here when it comes to the stock price. We saw some selling action, but it has at least pared back at least a little bit for now, Shauna.
Yeah, Rochelle, how worried should those investors be? Because H&R Block, it's still off almost 3% today on this news.
Indeed. I mean, when you look at it, I mean, they had already been preparing a lot of their lobbying service money. When you look at 18% and 29% for Intuit and H&R Block respectively. Now, they argue that they already offer a lot of these services, at least for the federal filing, for free. And some of these other fees that you see are more about the state filing, some additional or specialized fees there. But they're basically saying, look, keep in mind, there's already an existing free filing service that the IRS has. Now, that's if you're earning under $73,000. And according to the most recent survey from the Government Accountability Office, over 70% of people who are eligible for it, only 4% of people are actually taking advantage of it. So even though it's there, people not using it. Now, you might be wondering why. If you're eligible for this, why aren't you using it? Well, part of it is this concern about perhaps filing on a website at the same organization that's also going to turn around and potentially audit you at some point. You know, it's almost like a roach voting for raid. Why would I come in willingly to the IRS? That's not something that people are keen on. And also a caveat here that we saw from Kartik Mehta, who's a North Coast research analyst. He was saying that I guess what could break it is if the IRS said we're going to take all this information and create your tax return. So not really worried about the companies right now at the moment. He said they have strong balance sheets. And, you know, again, you're not necessarily going to want to sign up to the IRS's free service if you think it's going to get you closer to getting a little bit more scrutiny. I don't know about you, Diane, but I don't know how many people are that keen to do that.
Rochelle, I never thought I'd hear that on TV or digital space, roach voting for raid. All right, that's the takeaway right there. We'll keep watching this one. Rochelle Akufo, thank you so much. Coming up, it is almost time for the first closing bell of the week. Stick around, we've got you covered with everything you need to know after the bell.
We are just about 30 seconds away from the closing bell and checking in on today's market action. Once again, we have really been range bound as investors focus on the latest coming out of D.C. in terms of the debt ceiling negotiations, or really lack thereof, any progress on that front, and also awaiting some key earnings reports later this week. We have Home Depot on tap for tomorrow. We have TJX, Target, Walmart also in the mix later this week. For today, though, you're looking at the Dow up 29 points. S&P also posting gains. The Nasdaq, the leader of the three major averages. That does it for today's market action. Again, all three of the major averages closing just to the upside here, eking out some of those gains with the Dow up 56 points. Nasdaq up just about 0.6%. But let's get a quick look at some of the bigger stories of the day. And certainly investors are on edge as they do await for President Biden's expected meeting with congressional leaders tomorrow. Now, markets are coming off 2 straight weeks of declines. But Diane, like Keith Lerner did just tell us earlier in the program, he does think a deal could be a catalyst here for stocks to break out of that tight trading range into the upside. The number that he was looking at was 4,200, which has certainly been a resistance level.
Yeah, it has been a resistance level, and it will likely continue to be a resistance level, especially when you have this debt ceiling overhang. And, he juxtaposed it with what we saw historically. We went through this before in 2011 and the challenges that caused for the market and the U.S. credit rating, if you will. So hopefully we don't get to that level. There's been a lot of kind of political maneuvering and brinksmanship with regard to the debt ceiling. So that is certainly something that could help the market break out, honestly, one way or the other, what happens. So that's certainly something that we've seen that's putting some pressure on the market, or again, to your point, keeping us in a narrow range.
Yeah, it's been keeping us in a narrow range. I think everyone's just trying to figure out what exactly the next couple of weeks look like. Up until now, investors have largely been brushing off the fact that we don't have a deal down in Washington. That certainly has not been priced into the market yet.
Right.
If we don't get a deal soon, certainly a number of research notes have come out over the last week or so saying as we get closer and closer to that X date, this is no surprise. Markets will start to react to the risk of a default. So we could certainly see volatility enter the action, re-enter the action if we don't get a deal soon.
Indeed. And we're seeing shares of NRG closing the day higher. And this is on news. It is facing activist pressure. We talked about this a little earlier today. Elliott Management disclosing a position in the power company for the second time in 6 years. Now, Elliott wants a boardroom overhaul and a strategic overhaul. So this point that we talked about with regard to some activist investor action, we talked about Shake Shack as well within that context.
Yeah, Shake Shack's within the mix here when it comes to energy and what we're seeing there. We know that when Elliott Management enters the room, this is what we have been told from numerous guests in the past. Everyone straightens up and listens to what they have to say. So energy closing up just about 3% today. In terms of the activist investor activity over the last 12, 14 months, and even looking at what we've seen so far this year, it has certainly been off to a strong start. More and more activist investors are targeting companies because of the underperformance, because of their cheaper valuations. And it's not just some of these smaller companies. You're looking at energy, and then you also have Disney, Salesforce, some of the activist campaigns that they have faced over the last several months here. But when you take a look at the numbers, Q1 activist campaigns, 36% were initiated at companies that had also been targeted by other activists in recent periods. So certainly just points to the fact that they're under a tremendous amount of pressure from a number of investors.
Indeed. Yeah, and Elliott saying they didn't like a move that NRG made for agreeing to buy a home tech company. That's Vivint Smart Home. They didn't like that move.
Yeah, a lot of times they try to shake up the board. It's just one of the things that Elliott is pushing for here. All right, let's take a look at Crocs because shares jumping on a note from Baird, calling the stock a fresh pick for 2023 and also saying that the company can meet or exceed guidance this year. We know that Crocs has been a name here in focus over the last several months. It did get some momentum here. Certainly during the pandemic, it was a pandemic favorite. You're looking at gains of just about 2.5%. Baird thinks a lot of people are going to be heading out to the stores and buying some Crocs soon.
I guess so. I mean, but they needed this win. I guess to them, a win is a win because recently they faced some pressure. They were a pandemic darling, but then they saw issues with regard to Hey Dude. The sales weren't as strong as expected there, but the stock has not been in favor as much. I mean, in terms of the Wall Street popularity contest, it lost some of its luster. So, you're looking at that downward trend that they had, and it's kind of starting to come to a lateral move. So they definitely needed this win today.
Yeah, they did. And you're looking at losses of almost 6% here over the last 3 months, Diane.
Indeed. All right. We are heading into the last peak week of earnings season with retailers taking the center stage. Joining us now to do a deep dive is Christine Short, Wall Street Horizon Vice President of Research, and Oliver Chen, TD Cowen Senior Research Analyst. So, Christine, let's get right to you. What are you anticipating most from retail earnings in the week ahead?
Yeah, well, it depends who we're talking about. It's going to be a mixed bag, as it often is, but there's 4 key areas we're looking at for this week, and that's the home improvement retailers, the discount, off-price, and fast fashion e-commerce. Of course, as you know, for home improvement, that was sort of a darling coming out of the pandemic with Home Depot and Lowe's, everyone kind of rushing out and, making large ticket purchases of appliances and doing DIY projects in their houses. And this has sort of softened, right? We're not as home as much, and inflation and higher interest rates have crept in. So folks aren't as willing to take on those large projects as they once were. And you can see that in analyst estimates. Home Depot and Lowe's expected to be down year over year on both profits and revenues. Next, I think discounters and off-price are two areas that are going to be winners this week. So on the discount front, you've got Walmart and Target. If I had to pick a winner, Walmart's really been outpacing Target. They're expected to be up year over year on both top and bottom line. Target is expected to see profits fall about 19%. Why? Well, Walmart has a larger share of the grocery space. We know everyone's really been focused on staples. If you get someone in for their groceries, perhaps they look around and they shop more. Also, e-commerce. Walmart's really just, hit it out of the park when it comes to e-commerce post-COVID. And they're also not only retaining their regular customer base, but they're getting higher income customers that are trading down. Same with off-price. We have Ross Stores and TJX companies out this week. This space has been really hot, right? Because those that are not maybe typically shopping there are starting to trade down. They're looking for bargains. They're looking for value. And both of those names are expected to do well. We've seen even the department stores like Nordstrom and Macy's really focus on their off-price segments. And then just lastly, fast fashion. We're looking at Boohoo. That is a British e-commerce retail loved by Gen Z and TikTokers. They own brands like Pretty Little Things and Nasty Gal. They haven't been doing so well. Yeah. We have an indicator that shows they push their earnings date back actually 2 weeks later than usual. Academic research shows when you push your earnings date back too far, it's usually positively correlated and highly correlated with bad news coming on the call. That wouldn't be surprising. They already said in their first half call that sales would likely be down 10% this year. And we saw what ASOS reported last week. ASOS is cutting costs and struggling with profit margins as well.
Yeah, certainly some worrisome trends. Oliver, let's drill down into Walmart. It's one of the big reports that we will be watching this week. I know you cover that name. What are you expecting just in terms to see some of the trends? Because consumers have been trading down and have been going to Walmart.
Yeah, Shauna, it's great to be here. The big story here is value, save money, live better. What Walmart does really well is everyday low prices. Also, about 60% of the assortment is food and essentials. That's been a category that's been working due to both inflation and as well as Walmart offering exceptional value. Walmart's also tech enabled. So it's save money and people, but it's about technology too. And Walmart Plus, their membership program has 24 million members based on our estimates. That's getting more high-income shoppers. And what's happening is this new generation of omni, meaning curbside pickup, buy online, pick up in store, and really flexing up on convenience. Higher household income customers, as well as value-seeking consumers like Walmart. Conversely, at Target has more discretionary goods. Think home, think apparel, think Target. A smaller percentage of Target is food. So we're watching these trends. Discretionary is very difficult to be in right now, given the inflation trends and given the pressure in the economy. However, on the positive side, the consumer's mixed. There's over $900 billion of savings on the sidelines and unemployment low at 3.4%. So there are cross currents with the consumer. The bottom line is all consumers are looking for value, and that's a key theme that we'll see. We also like very premium luxury goods. Our top idea here has been LVMH.
All right, Christine, I want to bring you back into the conversation here and talk about kind of the macro perspective. We've got retail sales out tomorrow. We talked about some key names in focus this week, of course, Walmart, Home Depot, et cetera. What are you looking to come out tomorrow, and is there anything that would surprise you?
Yeah, look, right now, the expectation is that retail sales are going to rebound from March. We're looking at the April reading. By how much, we don't know. And X autos and gas and building materials, it's actually expected to be only about maybe a 0.3% increase. We'll see. I mean, a lot of the consumer data that we've seen recently isn't looking so good. If you look back on Friday, University of Michigan consumer sentiment prelims came out and dropped 6 points. The reading dropped 6 points, showing that consumer confidence is waning. And you just mentioned the debt crisis. That is something that consumers are acutely aware of. Not only have we been talking heavily about a potential recession, whether that be mild or moderate, happening towards the back half of the year, that's something investors have, consumers have been concerned about, but now they're worried, what if we default on national debt for the first time in history? What does that do to jobs? What does that do to retirement benefits? So they're acutely aware that that could be catastrophic. I think some other numbers we're looking at are Bank of America's credit card spending was, at its lowest level in 2 years. We had New York Fed out with consumer debt at the highest level ever today. And that wasn't from mortgages. Mortgage originations were the lowest they've been since 2014. Oliver talks about jobs. Yep, jobs numbers have been one of the steady things that has kept consumers resilient in the face of inflation and increasing interest rates. And we've been talking about that for the last year. But I think you're starting to see that waver a little, especially with initial claims out last week. Ending the week of May 6th, initial claims were at their highest level in a couple of years. And so you're starting to see the jobs picture break down a little bit. And when you look at some of these sentiment surveys, you can tell consumers are starting to think about that. And I think they're trading down, and you're going to see that in some of the retail results this week.
Oliver, you mentioned luxury retail. Oh, go ahead, Oliver.
Consumers are becoming more choiceful. So what we're seeing is volatile traffic trends and consumers pausing and also delaying. On the other hand, parts of luxury goods remain very robust as the whole world goes out again and travels. Think about handbags, think about beauty and wellness and health being the new wealth as very good key themes to pay attention to for the long term. Also, what's really important for investors is, which stocks have pricing leverage. And there are stocks like Louis Vuitton and Dior that are able to price despite this difficult mixed environment.
Yeah, Oliver, I was curious just about LVMH, why that is a top pick within your coverage list, given the fact that we really have seen strength across the board, it seems like, when it comes to a number of these luxury names.
Yeah, what we're excited about is the gradual reopening of China. It's a key positive. The Louis Vuitton flagship brand has done a great job being very culturally relevant with Virgil Abloh and Pharrell Williams. Also, they've been able to achieve very nice price increases. Lots of people around the world love Sephora too. It's a phenomenal beauty concept. It's about 20% of the business. And Louis Vuitton is the largest market cap company in Europe. So what that really means, quite simply, is they have $7 to $8 billion of advertising and promotional dollars to spend. And big can get bigger in the context of that, because what happens is, I teach a class at Columbia University called Magic and Logic. Part of luxury innovation is magic, and that has to do with spending money towards making these highly emotional flagship experiences too. So these are very sustainable brands for the next hundreds of years. And that's why LVMH has been an attractive idea for us. We also like Costco, keep in mind, as we think about the bow tie approach and going high and going low and being selective.
Well, Oliver, it's so interesting that you mentioned that, because that's one of the things I thought about, especially because, Christine, you mentioned the possible headwind of a potential recession and what that can do to the consumer. Christine, let's ask you really quickly, and then Oliver, if you want to chime in. I think we know your answer, Oliver, but who are the winners in this environment with the pressures facing the consumer?
Well, like I said, certain discounters, Walmart, and then I would say the off-price retailers are those that have an off-price segment. I'd also say leisure is still strong. Oliver kind of mentioned that. We've seen good numbers from restaurants. We've seen good numbers from the airlines. Maybe not necessarily for Q1. Some of the international carriers reported numbers that missed or weren't as good as expected. But if you look at bookings going out into the summer peak travel season, bookings were, a lot of them showing record amounts of bookings. And we've seen that with even some of the hotels, Hilton, Marriott, maybe not necessarily Airbnb. They came in lower than expected when they reported for Q1, but some of the hotel chains really still doing well. We see a consumer that is transitioning more of their discretionary income over to experiences, maybe away from things in certain scenarios. And I think that's still the impact you're seeing from the pandemic. People don't want to miss out anymore, so they're willing to spend on certain things.
Oliver?
Yep. It's all about bricks and clicks and even portals and AI as we think ahead. Walmart's very well positioned. When you think about artificial intelligence, one of the key aspects of this is the training models, which very simply means Walmart has a lot of data, which they can really harness for the membership program. That's something we're excited about going forward. Thinking about Costco, it's back to basics. Everybody loves Costco, and there's lots of things you find there that you never knew you wanted in that treasure hunt. It also offers exceptional value. And then LVMH is a top idea. As I mentioned, the scale, the cultural relevance, the real dominance in luxury goods is very impressive. So the barbell approach is the theme. Go high, go low, think about value. And we're watching the US consumer, which continues to be fairly volatile, but we are in a consumer discretionary recession. So we've seen negative trends in discretionary. The bright spots are beauty, health, and wellness. I think health will be a great structural trend to follow, everywhere from physical to mental to being beautiful. And then TikTokification, that's another thematic thing we're paying a lot of attention to. I think Gen Zers will think very hard about sustainability as well as short form video for the long term. So lots of excitement in retail too.
Lots of excitement. That is short and Dean. And again, Gen Z trends, so important here when we talk about the future within retail. All right, Oliver Chen, Christine Short, thanks so much.
Thank you.
Well, still to come, some people receive financial advice from the TV or a book, while the younger generation is learning the state of financials from TikTok. We've got more on that when we return.
Young investors are flocking to social media platforms like TikTok, Reddit, Twitter, and Instagram for financial advice. But is that the best path to solve their financial problems? Let's bring in Ross Mack of Macconomics to discuss. So Ross, let's get right into this. I think you may be a little biased, but what's your takeaway? What's your thought?
Well, here's what I think. I think, once again, thank you so much for having me. Here's what I'll say about social media in general, right? I think it is finding a way to just democratize access. For so long, people have obviously thought about talking about finances as either taboo, or the simple fact is, though, you didn't necessarily have access to the right information. And I'm not going to necessarily say everyone on social media is disseminating the right and the accurate information, but what it is doing is starting to have a conversation. And the younger you actually start speaking about it, I think obviously the better it will be long term.
Yeah, Ross, I think a lot of people out there, they do turn to social media, obviously, for financial information. When you take a look at some of these numbers, 52.9 million views to date for the hashtag payday routine. So there clearly is a massive interest in this. How do you figure out who you can trust and who you can't? What's your advice out there to the users, other than that they can probably trust you?
Yeah, well, I think what it really boils down to is doing a little more research and digging to actually see if this person that you're following does have credentials. Because what I think social media is doing is giving you the ability to, one, have the conversation, right? Making you say, okay, I didn't know I needed to know about this. And from there, I think everyone can then in turn make a quick Google search, whether it's the actual topic that individual is talking about, or if you're actually doing a Google search for the actual influencer that you're following.
So, Ross, I want to ask you, one of the data points that we've looked at is the number of people living paycheck to paycheck. And you're seeing that nearly 2/3 of Americans still live paycheck to paycheck. So about 60% as of March. So what is your advice on breaking that cycle?
My advice is going to be very simple. You have to control your spending, right? It's when you really see a number like that, most people are going to say, oh, well, maybe it's because, the minimum wage is too low, right? At the end of the day, when it comes to 60% of people living paycheck to paycheck, people making over $250,000, almost a third of them are also living paycheck to paycheck. So it's never just you need to make more money. What you actually need to do is find better ways to actually control your spending, right? Actually hone in what your expenses are. And the way you do that is create a budget, right? Everyone needs to be able to control their inflows and outflows to ensure that they're not living above their means, right? It's obviously one of those things that is not a sexy thing to do, but by truly writing down what your income is, right? Your after-tax take-home pay, you quickly can see if you are spending too much when it comes to dining out, or if you're spending too much when it comes to swiping on your favorite website, that maybe if it's Amazon, right? But at the end of the day, writing it down, having a quick 50-30-20 rule will ensure that you yourself aren't living above your means. And as you can see, the average person is.
Ross, you tackle a number of subjects, and one of these, if you're trying to figure out what exactly your wealth is going to look like in the short term, you got to be keeping a close eye on what's happening down in D.C. You just did a video on this. I'm curious, though, from the traction that you've seen and from what you're seeing, the trends from your followers, are they worried about the debt ceiling negotiations?
What I will say is I think that there will be a deal to get done, right? Historically speaking, this is obviously, a left versus right, a Republican versus Democrat type of thing, and who's maybe going to fold and concede first. But at the end of the day, I think that I would hope that they put the American people first, and I do believe that a deal will get done. And so what I would say to any individual from an investor standpoint is, in the short term, there might be a little volatility, but in the long term, history has always shown that they get it done, right? I think that we'll get it done.
But Russ, I'm curious, so Main Street, the younger viewers that you have following your platform, do you think they understand or really, grasp what's at hand with this?
No, I don't, right? What I will say is I was an intern in 2011, right? And it was very interesting to even see that. I was at Morgan Stanley interning at the time, and it's very interesting. But what I will say is that the younger generation, I don't think they understand the brevity of what could occur, right? If we were to ever to default, right? If we are no longer making Social Security payments, right? If Medicare is gone, right? I think that at the end of the day, younger investors need to understand that be a long-term investor. You shouldn't deviate from your plans when it comes to dollar cost averaging.
Okay, so Ross, I got to ask you just really quickly to explain. We have a mainstream audience as well. It's not just the Wall Street folks. What is 50-30-20?
Sure. When it comes to budgeting, I find it very imperative that you don't live above your means. And so the way you want to do this is take what you make on a monthly basis after taxes. And the way you determine if you're living above your means is you shouldn't be spending more than 50% of your after take-home taxes on a monthly basis, your income. You shouldn't be spending more than that on your necessities. The necessities are think of your rent mortgage, think of your food, think of health insurance, car note, etc. 30% after that, you can spend towards the things that you want to do, whether that is actually dining out, whether that's ordering Uber takeout, if that's vacation, etc. And then the last 20% you want to allocate to saving, paying down debt, and investing. Right now, the target when it comes to investing is you want to be somewhere around 15% when it comes to retirement planning. So at the end of the day, what you're trying to do is create this plan so you can get closer and closer to your retirement goal so that you can retire and not have to work until your demise.
Yeah, or to live off cat food. Ross Mack, our thanks to you again, as usual. Coming up, OpenAI CEO Sam Altman set to testify tomorrow at a Senate hearing. We break down what to expect and how this could impact the future of artificial intelligence.
Let's take a look at shares of SoFi. They closed the day to the downside here, falling almost 5% after Wedbush downgraded the stock from neutral to underperform. They also slashed their price target from $5 to $2.50. Analysts behind that call saying that SoFi's fair value accounting may present some headwinds here. And that analyst, David Chiaverini, which is really a friend of the program. He's been on the show a number of times over the last several months here. But Diane, the big concern here and why he does have that street low price target is because of their accounting measures and really how they are reporting. And he's saying that regulators could come in and suggest that they operate under a more conservative capital requirement framework.
Yeah, I saw that. Another thing I saw was SoFi's CEO disclosing stock purchases by his wife dating back to 2021. And why is that, kind of coming up now as a regulatory filing that, just showing that she had unloaded a significant amount of shares and just that this was in 2021, and so why is this kind of coming out now? I mean, although it's having an impact in general on the stock today, the downgrade, you still see some who still have it as, on the buy side, a buy rating, so it hasn't changed dramatically in terms of the other analysts and their position on the stock. But again, it definitely gives cause for concern with regard to SoFi, with regard, again, to the accounting methods that it used, what could happen with regard to its book value. So you're seeing that play out in terms of the numbers today.
Yeah, the stock was off about 9% in earlier trading, pre-market trading, closing the day off about 5%. So certainly a concern here on the street. No real surprise, because we know that Wedbush's David Chiaverini, when he does tend to post notes like this, publish notes like this, they do move the market. So this impact here on SoFi with the downgrade, having his price target to $2.50, about half of where it closed today. Clearly, he sees more downside risk ahead.
Indeed. On the flip side, Morgan Stanley maintaining its underweight rating when it comes to C3AI, another company we're looking at, the technology company specializing in artificial intelligence, AI. It pre-released its fourth quarter results this morning. They were above expectations, nearly above the guidance range issued within its Q3 earnings. The stock finished up 23%. Revenue came in at $72.1 million. So that was better than expectations. And, you know, C3AI had been a big beneficiary of just all the chatter around AI. Investors had piled into that stock, and they kind of backpedaled back in today.
Yeah, well, there's certainly been a lot of activity when it comes to C3AI. The hype around ChatGPT, what we've seen from OpenAI, clearly playing into that. We're looking at gains of over 100% since the start of the year. So you can see that AI frenzy, the appetite for investors to have exposure to AI, that's clearly reflected in the stock price since the start of the year. But what also caught my attention was the response that we got here from the company in terms of it after being targeted by short sellers. Now, they were targeted by Spruce Point and Kerrisdale, and the company coming out saying that they conducted an independent investigation with outside counsel and auditors and found no wrongdoing. They also went further with that and said that the investigations, quote, found that none of the allegations or insinuations of wrongdoing made by either Spruce Point or Kerrisdale were supported by the facts, and no irregularities, misrepresentations, or omissions in the company's prior disclosures were identified. We know that that has certainly been a headwind here for the stock as of the last several weeks. But again, shares soaring today, up more than 100% since January 1st.
Yeah, indeed. All right. And speaking of ChatGPT, OpenAI CEO Sam Altman is slated to testify tomorrow at a Senate Judiciary Subcommittee meeting on regulating artificial intelligence. Yahoo Finance's Ali Garfinkel is here with a preview. Ali, what can we expect?
Hi, Diane. Speaking of ChatGPT, I feel like we're always speaking about ChatGPT at this point.
Right.
And I think one of the key things to remember here is that OpenAI built ChatGPT. So I'm going to say there are probably three things to watch here, but number one, unequivocally, is ChatGPT. I'm expecting lawmakers to expressly ask about ChatGPT. Remember, it's the app that started it all. And remember, it is also the fastest app to reach 100 million users. So it's made a bit of history. But there's also a lot that I think lawmakers feel like they don't understand about it. What the risks of that app specifically are, who it is for, and what kind of protections that OpenAI has in place currently. So number one, ChatGPT, we're going to be hearing that name a lot in Congress tomorrow. Number two is I think we're going to see a broader discussion about key risks for AI at large. Things like misinformation, privacy, concerns about bias. I'm expecting to see lawmakers ask questions like the kind of data these apps are built on and what companies are already doing, like OpenAI, to really make sure that they're protecting consumers. And I'd say the last thing to really consider here, number three, is this is going to be something we don't often see in Congress, bipartisanship. Now, it's important to remember that this is being convened, this hearing at the Senate Judiciary Committee is being convened by Senator Richard Blumenthal and Senator Josh Hawley, who both are respectively a Democrat and a Republican. So we're going to be seeing some questions across the aisle. Now, the last thing here, though, remember, the subtext for this all is, what does it mean to regulate AI?
And Ali, what does it mean to regulate AI? Because there certainly has been this massive push to do so, but it's a pretty tough task.
It's an incredibly tough task, Shauna, and you're right, I don't have all the answers. However, I think there are a couple of key things that are making it difficult. The first is, number one, every technologist I talk to says this is developing fast. And when something is developing as fast as AI is, it's really hard to regulate it. The other thing to consider here is we don't necessarily have a lot of good models. You know, one expert I talked to recently said that Europe's models that it's putting forth are actually both too vague and too strict to really be applied successfully. And it ultimately comes down to a very fundamental problem about regulating technology and AI at large, which is that too much regulation, if you push it too far, you're going to stifle innovation. But if you don't regulate at all or don't regulate enough, consumers are in danger. The way I would put it, Shauna, is that AI regulation has a Goldilocks problem.
Yeah, certainly. And the regulators, they want to do everything they can in order to crack down on AI, but how they do it, that is the big question right now, right? Ali Garfinkel, great stuff. Thanks so much. Well, coming up, former United Airlines CEO Oscar Munoz joined Yahoo Finance earlier today. We take a listen to what he had to say about the state of airlines. Stick around. Goldman Sachs getting the pulse of where the ultra wealthy are looking to invest this year. Joining us now is Sarah Nason-Terrajano, Goldman Sachs Global Head of Private Wealth Management Capital Markets. Sarah, it's great to see you here. So you're out with a new report. You spoke to a number of family offices. One of my big takeaways from this report was this risk-on attitude, the sentiment that you guys found speaking with all these family offices. What do you think is driving that?
Yeah, and I would say, look, the reason that we've talked about this risk on sentiment is that we see a number of families talking about looking to invest in equities in the future even more. So 48% say they're prepared to invest in equities in the future in the next 12 months and over 40% in alts. I think that really comes down to family offices being a very nimble investor base who can act when others are running away from the market. You have to remember, they aren't answering to a set of outside investors. They don't have to worry about redemptions the way other investors do. So they can be in a position to act. And I think they are prepared to do so upon dislocations.
So, Sarah, I want to ask you, was there anything that surprised you in terms of this data? Because, so for instance, my perspective, when I was looking at the geographic allocation going forward, and I saw that only 26% of respondents plan to increase their allocation to U.S. markets. Talk to us about the breakdown of where they're looking to put their money, and was there anything that surprised you?
Yeah, I would say overall, in terms of the results of the survey, one thing I'll just start with is actually the allocations have stayed quite similar from our last paper published in 2021. And I think this is really a testament to family offices being patient capital and also the lack of leverage in the system. And so there hasn't been a need to really shift significantly the asset allocations. When we surveyed this group, In 2021, they had 45% in alternatives. Today, they have 44%. You know, in terms of why we don't necessarily see a higher move to the U.S., that is because this family office group is overwhelmingly overweight the U.S. and developed markets. And if you look at the U.S. investors in particular, they have 77% of their capital already in the United States. And so I think the focus, particularly in a more volatile environment that we've seen, you know, for the last 6 months, is to stay invested in developed markets.
Sarah, how are you advising clients in this very uncertain environment, given the fact that we had the debt ceiling showdown down in D.C. and also this higher rate and higher for longer, it seems like, environment here from the Fed?
Yeah, look, it's a great question. I would say our advice to clients is to really be calm. And that's what we've seen. You know, when we think about our role as advising clients, it's about preservation of capital. And when you think about what it takes to reverse capital, what really impacts the preservation of capital is permanent loss. And when you're a forced seller, that creates permanent loss. So we're advising clients to stay calm through these cycles. Look, they've experienced it through COVID when the market dislocated significantly in March 2020. They saw it in the great financial crisis. And I'll just throw a stat at you, and I tell this stats to our clients all the time. If you look back at the performance of the equity market from 2009 until today, from summer 2009, if you were out of the market for the 50 best trading days, so that's 50 trading days in what almost a 15-year period, you would have given up 100% of the return of the equity market. And if you'd been out the 10 best days, you'd give up almost half the returns of the equity market. So what we're telling clients is don't panic, look at dislocations as ways to create further exposure. I will say that our family offices are really disciplined and focused right now. The bar for investing is high. And I would say we definitely have more muted equity market return expectations over the next 6 to 12 months. And so you've probably heard us talking about this, but we're spending time on things like private credit, given that you can get to double-digit returns in private credit today. And that's an area I think our family offices are spending a lot of time. Within equities, they're really focused on balance sheet, path to profitability, margins. There's a lot of discipline around making sure they're invested in companies that can weather the storm of market dislocations.
Sarah, you mentioned 2009. Back then, crypto was a blip. Let's talk about alternatives in general. And what is the feel? So you also mentioned private credit as well. What is the sentiment around crypto and alternatives in general?
Yeah, that's actually a great question. And when you ask me what surprised me most, that might be, I'll start with crypto and then we'll talk about alternatives. I would say the crypto response surprised us a little bit. What we found on crypto is that family offices have really made up their mind about crypto. And so if you read the report at first glance, in 2021, we only saw 16% of our family offices invested in cryptocurrencies. Today, that number is 26%. So you might see that and say, well, more people are invested in crypto. But actually, if you look at how many people were invested for the future, that went from 45% in 2021 to only 12% today. And what I'd say about crypto is we've got a group of family offices that absolutely understand the space. They're comfortable with the volatility. Many of them have experience as public market investors and can manage that volatility. But I would say less families are engaged in crypto than they were in 2021. The picture for alts, sorry, just real quick. The picture for alts is a little bit different. Our families are very comfortable with illiquidity. And what I would say about that is when you have family offices with significant pools of capital, they've seen the outperformance of alternatives over cycles versus public assets. They're comfortable with that illiquidity. It allows them to be patient. They definitely take a vintaging approach where they look to add exposures each year to sort of average into their exposures in alts. And as I said earlier, these family offices have some of the largest allocations that we've seen to alts in investor base. So 44% of their assets in alternatives.
All right, we got to leave it there. Sarah Nason-Tarajano of Goldman Sachs, thanks so much for joining us.
Thank you so much for having me.
Meanwhile, former United Airlines CEO and author of Turnaround Time, Oscar Munoz, joined Yahoo Finance Live earlier today to discuss the current state of the air industry ahead of the summer travel season. Let's take a listen.
Part of leadership and involving large companies, especially that service the consumer, you have to think ahead. And I think one of the things that United did well over the course of that lull, right, we lost 93% of our revenue. is to think ahead and invest. So we kept investing in our aircraft to keep them maintained, and we were able to use a lot of money to train our folks to be ready. But nevertheless, it is a double issue, and with demand coming as hard, people want to travel. It's amazing how people are, as you've seen, and so it is going to be a tricky posture, and some airlines will fare better than others, and deferred investments that, and obviously, are going to come back, and I think the airline you mentioned was clearly one of those situations.
Oscar, you're definitely not retired. You sit on a number of boards, recently Salesforce as well. What's the biggest challenge leaders are up against at this moment?
I think the economic climate, right? I mean, everything you hear is about economic uncertainty. The debt ceiling is the current issue. You got the work from home. You have a shortage of. I mean, it's just it's always tumultuous, but it's particularly tumultuous, and it's hard to see ahead of the corner. So I think the most important thing, at least in the boards that I follow and the senior managers and CEOs that I work with, it's from board perspective, we just try to keep looking ahead. What is it that you do best? Let's keep doing that well. Let's discuss it, and let's get the organization lined up behind it, and then tell investors in a very transparent way what's ahead. And cycles are cycles. We've all lived through something. This cycle will end, and you have to be ready for the top end of it. So but the tough thing is staying focused when you have all this noise around you.
Speaking of cycles, you've experienced some cycles of your own, so to speak, as well. You write in your book about your heart attack followed by a heart transplant, and that's a situation where your body is telling you have to slow down. You do not have a choice. How has that fed through to leadership? And I think about it because especially right now when leaders are managing millennials, for example, and now Gen Z coming up, who have a different approach to work, how has that kind of informed how you think about all of that?
Resilience is a wonderful term, meeting turbulence, all of those things we talk about in a trite way. When you face a life-altering, potentially life-ending situation, you really do get to appreciate what's wonderful in this world. And for me, going back to work was an easy conversation because of the outpouring of support I had from my united family. But yeah, work is work, and you talk to anybody that's accomplished anything in life. When they go back to those early days, I'm sure all of you in this room, there's a portion of your life and career where you just have to work hard and do work that maybe isn't what you want to do eventually, but you'll get there if you put in the effort.
Does this next generation, just building on what Julie asked, do they have it?
You know what? I have children of this age, and I know many people, and I stay very close to this. And there's a lot of apps out there that give you a lot of insight. Yes, they have it. You just have to find the right mechanism and communication, listen and learn from them before you lead them. Because we all read these headlines, well, Gen Zs are this and millennials are that, and it's like they're not all that. It's like you have a conversation with your people in your environment, create your own culture, and I think you'll learn a lot about how to apply it for you and your company, not what everybody is. You can't label people. I think if you ask many of them, I think they hate being labeled. It's like we don't like being labeled, and so why is it okay for do that? So yeah, they have the stuff. They just need to learn. And if you look over history, the original Gen X, right? Where are they now? Well, they have mortgages and children and family. Right? We're not working for a living, so it'll all evolve.
Even within that, we talk so much about hustle culture or grind culture all the time, which is essentially just a nice way to say workaholic in some cases. But do you think that's pivoting now with new technologies such as generative AI even, or the different tools that we can leverage as a resource to drive a more efficient culture, if you will, among employees, among the workforce more broadly?
So a lot of questions in there. So I always say, everyone wants to work for a good living. Increasingly, we also want to live a good life. And the definition of good life has changed given COVID, because we got to experience things. People stay home with their kids and all of that. So good life has been defined. So you have to understand with that regard. New technology is wonderful as long as it doesn't make you lazy, right? I mean, it's like you just can't dial it in and say, hey, Chad, put this presentation together. And again, we worry about that aspect of that. I was just at an event that somebody said something I think wonderful. There's fake gold because there's the real gold, while there's artificial intelligence because there's real human intelligence. And I think that's a really important part for us to remember. We are not going anywhere, and our brain capacity shouldn't go, and we shouldn't allow it to go easily into that good night of using other people to do our stuff for us. So it'll be a combination.
Oscar, you're writing in the book about your upbringing. I believe you and your mom came over from Mexico or immigrated here to the United States. Just curious on where you're at, where your emotions, your head is at as we gear up potentially another contentious election in this country?
You know, this will sound like I'm running for office or something, but I can say this from experience and the thing we were able to solve at United. You have to have two sides of a conversation that want to move forward and do the right thing. Increasingly, in a lot of our social issues, it's like yes and no, or red and blue, and they're such polar opposites. There's no one yearning for a solution that brings us not only together but forward. And I think with regards to immigration, it's a very, it's heated on both sides, and I think if somebody were just really somebody or a group of people would, I know it's complex, but if you just started with the concept, let's solve this. For the practical reality that it's required, we need workers in America. How do we manage that process? And if we started there, I think we get more progress. But now, all immigrants are bad, and you should let everybody in the world in. Just two polar opposites. So I've always been able to bridge gaps between two, chasms in some cases, and I just don't think we have that civil discourse anymore. We just go to our respective sides and really, really push hard, and nothing gets done, and we sit here trying to resolve this issue time and time again.
All right. Our thanks to Oscar Munoz for that time today. Coming up, we check in on a few tickers moving after hours and get you set up for Tuesday's action.
Got a number of stocks here trending after hours. So let's take a look at a number of them. First up, we're going to talk about some movement that we have seen from the 13F filing from Berkshire Hathaway, Warren Buffett's company, making some adjustments here to its portfolio in terms of what they did add, what they boosted their Apple exposure. It's now the biggest holding, representing 46% of the disclosed assets there. Occidental Petroleum, they also added to their position there, as well as Paramount. Occidental Petroleum now represents 24% of its outstanding shares. You're looking at those three stocks. On the flip side, in terms of what Berkshire reduced its stake in, you're looking at three names as well: GM, Chevron, and Amazon. When it comes to some of the regional bank plays, an interesting move here from Berkshire Hathaway. They took a stake in Capital One, while they also exited their holding in BNY Mellon. And Capital One, this movement, you're looking at a pop of just about 5.5% in after-hours trading. Also coming on news that Bridgewater slashed their position in Capital One here. So certainly Berkshire and Bridgewater viewing the future investment in Capital One a little bit differently here, but we're looking at shares pop in after hours as Buffett does take a stake in Capital One. When it comes to some of the other news that is moving after hours here, let's get to some earnings reports, and we have Beam Global. That stock on the move, with shares gaining just about 12% here. A strong report from the company that has the technology with EV charging, also energy storage. They've posted a narrower than expected loss. Also, their revenue beat the street's estimates right around 13 million. So we're looking at that stock pop in after hours. And also rounding it out with Tesla, another name to keep on our radar tomorrow, off just about 0.3% in extended trading. But the real news is going to happen tomorrow. The company holding its annual shareholder meeting that will take place in Austin, Texas, at one of its gigafactories down there. Diane, so when we take into account, I guess, what we could hear, they are going to be voting on 5 proposals, one of those executive pay.
Exactly, and that one is one of the more controversial proposals that'll be on the table, and the vote is going to be about whether it's going to be reviewed every 3 years versus just an annual review. So that will be one to watch tomorrow. Another one will be just the share price has definitely taken a hit over the past year, down more than 30% over the past year. And what Elon Musk has to say, especially now, he's going to have one less hat to wear.
He's going to have one less hat to wear. And you would also think that shareholders also want to know the answers just in terms of production, any timeline on that when it comes to deliveries, what that looks like, given the fact that there was a heck of a lot of pressure on their margins this past quarter. The company took an interesting strategy here, or approach, I should say, to the pricing of its vehicles. They have moved up, they have moved down quite a number of times since the start of the year. They are lower than where they were January 1st, but any insight into the future of pricing will be a focal point.
It will definitely be. We'll be watching that one. Meantime, it is closing time here at Yahoo Finance. Let's get you caught up on some of the biggest stories of the day. First, consumer debt surpassing $17 trillion for the first time ever in the first quarter. According to the New York Fed data, auto loan and student loan balances both increased, as did mortgage balances. Credit card balances, however, were flat.
European Union regulators officially signing off on Microsoft's $69 billion acquisition of Activision Blizzard. However, the companies still have to contend with challenges from the UK and also US regulators.
And looking ahead to tomorrow, we will be watching a Senate banking hearing on the collapses of Silicon Valley and Signature Banks. In his testimony, the former CEO of SVB says, quote, rumors and misconceptions spurred an unprecedented bank run. He also says the day before it was shut down during a 10-hour period, SVB lost roughly $1 million in deposits every second.
All right, well, that does it for us today on Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern Time. We've got all your coverage leading up to and after the closing bells. Have a great afternoon.
Thank you.